Good morning. Welcome to Lerners Private Lending Breakfast and Learn, and thank you for joining us this morning. My name is David Lyons, and I'm a partner and the practice group leader of the business law group at Lerners. The purpose of this morning's session is to provide you with updates and insights for those in the private lending sector on various legal and related topics we have chosen, and for this we have chosen 4 exceptional speakers and experts in the field to ensure you get the most out of the morning. Before you get started, I do want to let everyone know that the seminar is being recorded and a copy will be available should you wish to sign up after to view it. To begin, we'd like to take a moment to acknowledge the land we are situated on this morning. We acknowledge that this morning's seminar is situated on the traditional lands of the Anishinaabe, Haudenosaunee, Lenape, and Chungnocton nations, on lands connected with the London Township and Sombra Treaties of 1796 and the Dish and One Spoon Covenant Wampum. With this, we acknowledge our respect of the long-standing relationships with Indigenous nations and accept that we have a responsibility as part of the business and legal community to work toward building respectful relationships on the path toward reconciliation. It is now my pleasure to introduce our first presenter this morning, Clark Armstrong. Clark is an associate in Lerners' Real Estate and Land Development Practice Group. His practice covers a wide variety of real estate law, including private lending, commercial financing, municipal law, and property development. And today he will be discussing considerations which apply when different lenders have registered their security on the same property or wish to. Let's hope that they know that. So please welcome Clark Armstrong.
Thanks, Dave. So as Dave mentioned, I'll be talking about sort of what considerations apply when you have multiple mortgages being registered on the same property or the intent to. So the first sort of agenda we'll go over here is what considerations you need to be thinking about if you're going to be in second priority on a mortgage, or conversely, if you are in first priority and you've been contacted by somebody who wishes to register a mortgage in second priority. So we're going to be looking at privity of contract, which sort of addresses the relationships or contractual ties between parties on title. We'll also be looking at some of the sort of subsequent encumbrance permissions, or what that means is whether under a first mortgage you're allowed to grant a second mortgage on title. And then also we'll be looking at alternate security possibilities if there's insufficient equity in the property, or a later mortgagee wants to get some additional security. So the first term is privity of contract. So basically, as I said, what that just means is that we're looking to see whether the parties involved have a contractual relationship with one another. So obviously, if there's a borrower who's granting a mortgage to lender 1 and lender 2, that borrower will have a contract with each of the lenders. But lender 1 and lender 2 may not have a contract with one another, depending on the nature of their relationship. So that can inform things like when a second lender may be notified of a default. It can inform what sort of disclosure obligations the first lender has to provide to the second lender. And that's something that we just like to consider at the outset. Is the first mortgage being granted and then a second mortgage following at a later date, or might both private mortgages, for instance, be granted at the same time? So these, when you look at Schedule 1, Big 5 banks, they have what are called standard mortgage terms or standard charge terms that set out sort of the nitty-gritty terms and conditions that apply to each mortgage. Pretty much, most of the big banks have these clauses reproduced here, which say you cannot subsequently mortgage the property without the bank's consent. So this is sort of the no secondary financing provision. These are not the same for all the big banks, but essentially it provides that, like I said, you can't subsequently mortgage without the bank's permission. And that can sometimes lead to considerations for second lenders who are thinking about going on title. So one way around this is what's called the mortgage priority endorsement from a title insurer. So this can apply to some second and third priority lenders. But basically what this title insurance coverage allows is that if you get this added policy for $75 or added endorsement for $75, you can obtain a mortgage information statement from the first lender, and it will provide sort of what the outstanding principal amount is on the date you're registering your second mortgage. On the basis of that statement, if that first lender later enforces and tries to claim more than the principal amount that's shown on that statement, this title insurance coverage will protect a second lender from whatever they're trying to claim in advance or in addition to that principal amount. So in terms of the mechanics of how this all works, it depends upon a first lender providing a mortgage information statement, which they may not do in time, particularly for tight closings. But if there is time to obtain such a statement, this can be a valuable way to for a second or later priority lender to be assured that they're getting, they know sort of what's in front of them, and they have a cap on their liability to what's in front of them. So that, like I said, is generally available for second position lenders. In some cases, it could be available for a third priority lender. We don't tend to see a ton of third priority mortgages, but it could happen. And then the next thing I wanted to talk about was some of the sort of alternate security options that could be available to a private lender who's maybe concerned about insufficient equity or security in a property. So obviously right now we're entering a period where the market is sort of softening. We've seen prices declining, and that can trigger some questions about what might be an appropriate additional or alternative security. So my colleague Nick Cummings is going to be speaking about some of the Personal Property Security Act options that are available to lenders to secure personal property interests. Generally with the private lending, we're talking about land titles and mortgages. So there may be other assets of a personal property nature that are distinct from the real estate assets that could be pledged to a lender. Another idea is increased reliance being placed upon guarantors. So we've seen a lot of transactions where individuals might purchase a property, they run into financing issues, and then they're having to go to their parents or relatives to be either guarantors or potentially being added to the title of property. And then the other idea is that maybe more in a commercial context, if there's related corporations or different properties that could be mortgaged, that's another possibility to obtain additional security for that loan. So that's about the extent of my presentation today, but I'll pass it back to Dave, and he'll be introducing Nick Cummings. Thank you.
Thanks, Clark. Too late. Any questions for Clark? We have a few minutes while we have him here before he gets seated. All right, hearing none. I also forgot to congratulate all of you for passing the first test in making it to the premises here today. The challenge of downtown London construction. The good news is when we finish at 10, you head home, you'll be there by supper time. Okay, next presenter. Nick is a partner in our business law and real estate practice groups. He has experience in a number of areas of residential and commercial financing work, including private lending involving residential, corporate commercial, and industrial properties for a variety of lenders. Please welcome Nick.
Good morning, everybody. And as Dave mentioned, thank you very much for braving the downtown London construction phase as we're nearing winter. It's definitely interesting getting to and from here, to say the very least. So as I try and figure out the technology here, you can take a look at the agenda about what we're going to talk about here this morning. And, my colleague Clark, he mentioned in private lending, oftentimes the focus is on the mortgage, right? On the real property security that lenders can use as collateral to secure their their credit and their financing. But along with that, a lot of the times in your commitment letter, you can really enhance your security package by considering other security options, alternative security options, which fall, at least in particular, under the PPSA. So what is the PPSA? The PPSA is the Personal Property Security Act. This is legislation in Ontario. It exists in provinces across Canada. Quebec is a little bit different. But it sets out sort of additional rules and requirements that lenders and creditors can have in personal property. So this would include things like accounts receivable, inventory, intangible assets. So if you're in the technology sphere, equipment, motor vehicles, anything that is essentially not affixed to real property. So this can certainly enhance a lender's security package, because if your borrower defaults, not only are you going to want to take over possession of the real property itself, but who's going to try and sell a home without appliances, right? That's certainly going to decrease the value of your collateral. Similarly, if you're lending out to income property owners, you might want to step into the shoes of the landlord, right? You can collect under you can assume the lease obligations, you can collect the rent, you can use that as cash flow to repay your defaulted loan obligations. So under the Personal Property Security Act, of course, the lender loans money to the borrower. The borrower promises to repay. If the borrower defaults, you need recourse, and that's where this legislation steps in, and it sets out a very prescribed form, a very detailed set of rules in terms of how you can enforce on that collateral and how you can protect your position. As I said, you step into essentially the shoes of the borrower. You can run a business, you can collect under those leases, and that secures your payment, and that gives you an opportunity to enforce on the obligations that the borrower owes. Not spending too much time on definitions, but in the PPSA regime, the debtor provides what's called a security interest in this personal property. The security interest then becomes part of the regime and competes with the priorities of other secured parties and unsecured parties. The PPSA does have limitations, so it doesn't extend to essentially all intangible assets or, for instance, insurance policies is one main exception that it doesn't apply to. But it does set out, again, the rights and remedies that secured parties would have. So when you're stepping into the shoes of the borrower there, what you're doing is you're enforcing on what's called a financing statement. So when you register, for instance, a general security agreement against the borrower or an assignment of rents and leases, there's a couple of different examples there. A financing statement is registered, and a file is created that names you as the creditor, right, as the private lender, and that names the debtor as the borrower there. And that file is what you can use to maintain your security, right? A lot of the times, especially in the commercial context, right, your term loans might extend, 1, 3, 5, 10, 15 years. And that file will allow you to renew, to amend your security. For instance, again, in the commercial context, if you lend to a corporation that subsequently purchases another business, amalgamates together, you can operate under that same file. You can maintain your priority position. You can enhance your security. Financing statements can also be assigned, right? So one lender decides that they're going to merge with another lender. You want to combine your security package together. Again, that file will allow you to maintain your security. So how does the PPSA registration work? There are two very key aspects that need to be established in order to make sure that your collateral is good. So the security interest must attach to the collateral itself. And then once it's attached, that security interest must be perfected, I should say. So what does that mean? Attachment. There are a few key elements that need to be established in order to make sure that you have proper attachment of that security. First of all, value has to be given. You can't simply register a security interest against a borrower if you're not getting anything in return. So oftentimes in the context of private lending, obviously the loan funds go out, the borrower is borrowing that, and then in exchange for that, they are granting a security interest in their assets, right? So that's consideration. It's a basic contract law element, but there has to be value that gets exchanged back and forth between the parties. Secondly, the debtor actually has to have rights in the collateral. So as much as I would love to pledge Dave Lyons' car as security for my private loan, If I don't actually have ownership interest in Dave's car, obviously you can't pledge that as collateral. So the debtor has to have ownership rights within the collateral that it is pledging as the security. Thirdly, there has to be some form of agreement between the parties, or there are some exceptions to that if you have possession of the collateral, it will count. But it's best to document the rights that are going to be exchanged between lender and borrower within a security agreement, right? That would be in the context of a commitment letter, or within the commitment letter, something like a general security agreement or assignment of rents and leases agreement. But there has to be some sort of documentation as between the two parties. Lastly, and we'll talk about this a little bit later on in the presentation, there can't be postponement, right? So if I am taking a security interest within that collateral, I can't have postponed or otherwise, assigned or granted my rights to another third party. So once the security attaches, we have to perfect it. This is the second of the two key elements in order to make sure that you have a properly enforceable security position. So just because you have attached an interest, you have stated that you have an interest in the collateral, that is oftentimes not good enough, especially in the circumstances where you're trying to enforce on borrower's obligations. So perfection can happen a couple of different ways. The most common way that we see is registration, right? As I said earlier, you have a general security agreement that says, for instance, I've got interest in inventory, accounts receivable, and equipment of the borrower, right? I take that security and I go ahead and I register it under the PPSA regime. That file number is created, and that is essentially notice to third parties and to everybody else that that security interest actually exists. There are other circumstances, again, a little bit more nuanced, where perfection can actually happen by possession of the collateral, right? So the secured party would, rather than own the collateral, they would take possession of it and they would be able to enforce their rights as against that collateral itself. Similarly, there's control. So control oftentimes comes up in the context of security, right? So if I am taking security, for instance, in shares of a company, right? One business wants to buy another business, they're entering into a share purchase transaction, private lender steps in and says, yes, I'm going to finance, some or all of that share purchase transaction. Control can happen under that share pledge agreement where an intermediary, whether it be a law firm or a registry, will hold on to those shares and will ensure that your collateral, your interest in those shares is properly maintained. So when it comes to registering, lenders use the PPSA regime, again, to give notice to third parties, notice to the world that they have a security interest in the property. Where this becomes a little bit more complicated, similar to what Clark was mentioning in his presentation, is if there's multiple security interests against the same debtor. Where do you rank and how do you enforce that security? Failure to be able to properly identify that you have attached an interest in the collateral and perfected it, right? So you have a registration that determines you have a security interest could invalidate your security, and that leaves you in a tough position again as a lender trying to enforce your rights in that collateral. So when it comes to understanding priorities, again, not to oversimplify things, but whoever is there first, right, is obviously going to have the best interest within that security. They're going to be the ones who are more likely to obtain the value within that collateral and apply that against the loan obligation. So the higher the priority of your registration, the more likely it is that you will get repaid out of the proceeds of either seizing or liquidating that collateral. The secured party that ranks against other creditors oftentimes also gets to enforce first. So if you have a second, third, fourth, fifth ranking secured interest in the collateral, there's a default under that lending arrangement. Might not all be parties to the same agreement. The higher up on the food chain that you are guaranteed to get notice, and you're going to be involved in any sort of enforcement proceedings, again, maintaining that position, maintaining that interest that you have within the collateral. To sum it up, when it comes to priority, a properly attached and perfected security interest is going to have priority against an unsecured party or an unperfected interest. If it's an unperfected interest against another unperfected interest, so for instance, somebody names a debtor improperly, or somebody didn't take the time to properly register a financing statement, so you sign up, a general security agreement, but nothing is actually registered formally within the system, no file is created. Unperfected, the first one to attach, so the first one to sort of maintain that attachment against the collateral is going to rank ahead of the one who failed to do so. When it comes to a perfected security interest against another perfected security interest. It's the one that typically registers first that will maintain priority unless there's some sort of intercreditor arrangement or priority agreement between the parties there. Oops. So within the PPSA regime, how do we go about registering? What do we have to do? What are the common steps that lenders should consider in the context of, establishing and maintaining this security? First of all, we want to determine the scope, right? So oftentimes it's the term sheet, it's the commitment letter that will provide for the scope of what that security is going to be, right? Is it a general security agreement? Is it assignment of rents and leases? Is it both? Are we taking another interest in the collateral? Set out that scope within the agreement. We want to make sure it's properly documented. Once that scope is established and you're looking to advance funds, you want to make sure that you are running searches so you can identify, again, who also has a security interest in the same collateral that you're trying to maintain an interest in. And when you're running searches, some of the things to consider, so oftentimes you'll get a report, right, that will say we've got 7 different registrations, 7 different files open against the same debtor, right? But we want to determine where we are going to be attaching that security interest to the collateral. As I said, there's different regimes under different provinces within Canada, right? So if you have a business that is operating, for instance, out of Ontario, out of BC, and Alberta, you're going to have to run 3 separate searches under those 3 separate different regimes to see who's secured and, again, where you're going to rank within that. In the commercial context, one of the things that we find as solicitors is oftentimes people aren't thinking about past business names, right? So if I'm company ABC that merges and amalgamates to become company DEF, there might be previous registrations against ABC that don't automatically get updated. There's no, unfortunately, sort of talk back and forth between, the Ontario Ministry regime that handles business name registrations, amalgamations, and amendments, and the PPSA regime. So you want to, as you're doing your diligence as a lender, determine, are there any past business names that we should also be searching along with the current business name that your borrower client is operating under? And then, as I said, jurisdiction is really important too. You also, when you're getting those search results and you're going through them, wanting to determine, okay, is it simply just one registration that happened? Has there been amendments? Has the collateral from that first registration been expanded? Are there discharge filings that you're going to have to know about? Are there priority agreements? Are there intercreditor agreements as between the secured parties that you're going to have to vet? All of these things are going to fall into your scope of due diligence that you do. So what are some problems? What are some things that you should watch out for when it comes to ensuring that you have appropriate collateral and security interests within the PPSA regime? As I said, changes to the debtor's name, that is probably one of the biggest things to consider. Similarly, changes in location. So if you have a client that you're a borrower that you're loaning money to who's operating out of Ontario, they go to renew the loan, and all of a sudden in the diligence process of renewal, you find out again they're operating in BC, they're operating in Alberta. You might want to expand the scope of your registrations to those other locations that they're operating within. Similarly, Clark mentioned the standard charge terms. When you're going through and putting together these types of agreements, you might want to put sort of positive obligations, positive covenants on the borrower's part to advise you of changes in the location of the collateral that you have security against, changes in their name, whether or not they're going to amalgamate. You want to be aware of that before that amalgamation goes through so you can properly update your security, amend it as needed. Again, in the commercial context, corporate reorganizations, you might want to have covenants again that allow you to ensure you can maintain and update your security registration, as well as changes in address and assignments and these sorts of things. When it comes to registrations, the first thing that you want to think about is the location of the collateral that you're going to be registering against. So again, if you're registering against a property, so you're loaning out, say, $1 million to a borrower who's got a property here in Ontario, you're going to register your mortgage against that borrower. You're going to register under the Ontario regime because that's where the location of the movable property is. But as that property starts to move, again, you want to make sure that you are updating your collateral as well. When it comes to intangible property, again, you want to think about that when you're coming to the registration piece there. So the location of your borrower client is going to be very important, and to ensure that you get that proper attachment, which is one of those two key elements. You also want to consider priority when it comes to the PPSA regime. So again, intercreditor agreements or priority agreements amongst multiple secured parties can be very important to make sure that you are getting the collateral and the security interest that you think you are getting. You also want to make sure that you build in, again, those positive covenants on the borrower's part to advise you of any claims that might have super priority, that might rank ahead of your registrations, even though you were there first, you properly attached and perfected. So these are a few examples of some of the different claims that can fall outside of the PPSA regime, but may also take priority over your security interest that you have. That also feeds into the due diligence and the searches that you want to have and the protections in place, again, to ensure that you are not falling behind in your rank, you are not sort of prejudicing yourself and your ability to recover. When it comes to ranking, we talked about the fact that priority agreements can assist with this. A lot of the times we find in the context of sort of general security agreement registrations, you might enter into a situation where somebody has financed a vehicle, for instance, right? You've got a borrower who's looking for a private mortgage to acquire a property, and they've got $30,000 outstanding to Ford Credit on an Explorer, right, that they're driving around. You want to make sure that Ford is not going to take an interest in the same collateral that you are, even though presumably it's only the car. But when you see these PPSA search results, a lot of the times they're registering against motor vehicles, but they're also registering against other, right? In that circumstance, you might want to reach out to your borrower client and say, hey, we want a letter from Ford saying that they have no interest in the collateral. So the appliances of the home, for instance, that you're trying to take security against. You might want to stop a letter saying, again, there's no defaults under those sort of credit arrangements that they have with other secured parties. If there's old registrations that are on there, we encountered one the other day where it was actually before the PPSA regime even came into place in Ontario, but there were these old chattel mortgages that still fell under the same search results that were from 1990. Presumably there isn't a default from 32 years ago that's still outstanding today, but that could be something that, again, could impact your security, could impact your perfection that you have against that collateral you're trying to get. So, ensuring that there are timely discharges, ensuring that there are proper releases of old registrations, that can be very important to maintaining your position. And similarly, again, if you want to ensure proper ranking, you want to get that first priority, and there's existing registrations as against your borrower client, getting payout letters, getting proper release language built in there, undertakings to discharge, that can all be very important as well. So that's an overview of PPSAs that we could talk about all day here. But again, if there's any questions before I take a seat and pass it off to our next presenter, I'm happy to answer any of those. Wonderful. Well, thank you, everybody. Really appreciate you coming out today. And again, if there's anything... Oh,
Stay there. I have questions. I've been making notes here.
My boss is putting me on the hot seat, apparently.
Practically speaking, when do these PPSA registrations come into play in terms of security in a private mortgage scenario? Like a particular one I'm thinking of is the rental furnace, and then how does that affect a lender?
So in that circumstance, if let's say you've got, for instance, Lyons or M&K Heating that's got an existing registration as against a furnace or an air conditioning piece of equipment there, you would be turning to that company that's got the equipment and asking for a postponement, right? So you're going in there, you want to make sure that you've got first ranking general security as against all of the the chattels, the movable property that isn't affixed. You would want a postponement from Reliance saying that you can go in there, you can enforce first, and then Reliance would have to postpone to you. And similarly, again, as Dave mentioned, you would also want to make sure, again, that in that circumstance, an estoppel, just a general statement that it's in good standing, that there aren't any arrears in that agreement as well would be very important.
I do have a question, Nick. Is this something like if we came to you, to Lerners, to do a private lending opportunity, would you immediately start going through the PPSA with us? Like, would that be part of the? would that be part of what Lerners does, or is that like an additional request for us to ask for?
So oftentimes when we're doing these sort of private lending transactions, I think the best outcome is we work in sort of a team approach, right? So as you're putting together your commitment letter, your term sheet that you're going to put to the borrower, let's discuss that. Let's figure out what sort of security you're looking for, right? I certainly think in that context, in the private lending context, you want your mortgage against the property, right? You want your assignment of rents and leases. Your borrower client decides, hey, maybe I'm going to move out of that property. I'm going to lease it out to a tenant, right? You want to make sure that you can step in, you can take over that leasing arrangement. You can apply those tenants' payments directly to your mortgage before any balance goes back to your borrower client there. As I said, the GSA could be very helpful as well too in terms of securing, the appliances and the sort of movable property that if you do have to, step in, if you're going to sell everything under power of sale or you're going to foreclose, you're going to take over ownership of the property, that you're getting sort of the whole kit and caboodle, right? That you're getting an entire interest in the property and they're not sort of stripping everything out of the house, that you now have to go in and do substantial renovations, make investments before you can market it for sale to a third party. So, I would highly encourage that becoming part of a sort of your standard procedure when you're putting together these sorts of things. And then, we would do a title search against the property. We would do, PPSA searches, execution searches. Do they have any sort of litigation within that jurisdiction that might impact, again, your ability to enforce against the collateral? All of that, I think, would be good due diligence kind of in the private lending context there. Wonderful. Well, thank you very much, everybody, and we'll turn it back to Dave here.
Thanks, Nick. Any other questions before we continue on? All right. I would now like to welcome Stephen Piper and Chase Dazrit from Stewart Title. Stewart Title is one of the largest title insurers in the world, and they issue both residential and commercial policies of many types, including owner and lender policies. They provide customized underwriting from a dedicated team of real estate experts, including on private lending matters, and we work with them regularly. They are recognized in the market for their ability to deal with and pay claims promptly should the occasion arise, hopefully not too often. Stewart Title is a proud partner of our firm and many of the lenders that we represent, and so we're very pleased that they've been able to join us today. And here from Stewart Title, as I said, we're Chase and Stephen. Chase Dazrit is the Assistant Vice President of Lender Relations and Director of Commercial Business Development. He has spent 17 years within the title insurance industry, and all at Stewart Title. Prior to that, he started his career working with various institutional lenders. He is an accredited mortgage professional holding an AMP designation and is responsible for commercial marketing and development of relationships with lawyers, lenders, and other industry professionals. And Stephen Piper is the Director of Commercial Business Development with over 16 years of experience at Stewart Title. Stephen has a background in the claims department when he started in his career in title insurance as a law clerk before joining the business development group over 10 years ago. Please help me welcoming Chase and Stephen.
Good morning, everyone. Thank you, Dave. That was half of my presentation that Dave just did there. So thank you for that. Again, we're pleased to be here. I'm going to talk to you a little bit about title insurance, if you haven't guessed. It's not a very sexy topic, but however, it is a necessity in today's marketplace. I think I broke it. As a title insurance company, of course, we're going to lead off with a disclaimer. Information on coverage, search requirements, and processes are provided for information purposes only and can change without notice due to specifics of the transaction, and generally at the sole discretion of Stewart Title. Always, and we say this to the lawyers, always refer to the insured policy of each transaction when advising your client about coverage. Because not every transaction is cookie cutter, and they're not all the same. We have our agenda set out today. We'll do our very best to stay within the time given to us and within the agenda itself. Now, a little history about Stewart Title, so a little humble brag. Stewart Title is federally regulated title insurance company. We're regulated by the Office of the Superintendent of Ontario, known as OSFI. Our Canadian office is based in Toronto. And we entered the Canadian market in 1988, issuing both residential and commercial policies across Canada, including Quebec. Stewart Canada is a subsidiary of our US-based head office, which has been in business since 1893. We've been around for a little bit. This is relevant to know, should we have a catastrophic event resulting in a claim, not only can we rely on the reserves held here in Canada, but those reserves held with our US parent should there be a need. As a company, Stewart's always promoted responsibility and transparency, collaboration, strategic partnerships, and our fundamental, Stewart Title has always promoted responsibility and transparency. Collaboration and strategic partnerships are fundamental to moving our business forward. We have industry-leading, as David said, legal expertise coupled with our financial strength and our global reach. And we have the ability to customize our policies to fit that of your client's needs. We take great pride, again, in our partnerships with lenders, owners, and members of the legal community. And as a value add, we offer a wide assortment of coverages across Canada through our commercial policy endorsements automatically at no additional cost to you or to your client. Unlike other insurance products, for a one-time premium, our policy covers and helps close your transaction in a timely fashion by insuring over matters such as defects, encroachments, title problems that otherwise might stand in the way of completing a purchase or mortgage transaction. The title insurance policy is enforceable as long as the property is registered to the original owner. Ratings are important in any industry. Title insurance is no different. The two companies that rate title insurances are Dimotech Inc. and Finch Rating Limited. With Dimotech, we received an A double prime rating, and with Finch, we have an A minus. Both ratings are strong indicators that Stewart can meet all its financial responsibilities to our policyholders. Now, what is title insurance? It offers protection to the insured from losses due to specific risks that would adversely affect interest in real property. In the commercial world, we offer two types of policies, one for the owner and one for the lender. The lender policy is often referred to as a loan policy, and nearly all institutional lenders request a loan policy to protect their interest in collaterals or mortgages for secured real estate. A typical lender policy will cover off defects in title, liens or encumbrances, the unmarketability of title, lack of access, enforceability of a mortgage, and the priority of any lien or encumbrance. It's important to remember that title insurance is retrospective. It insures covered risks prior to the policy date that arise after the policy date. The policy date is normally determined as the date of registration of the charge or transfer. A commercial policy starts out as a bare bones policy and is given coverage and teeth through the customization and the addition of endorsements. Why title insurance? Commercial deals can be challenging and complex. They're a huge financial undertaking, and by choosing title insurance, you have the additional layer of protection against future losses from unknown defects that existed when the transaction closed. It helps to reduce the due diligence required to complete the transaction. It also provides coverage over known defects uncovered during the due diligence period, allowing the deal to close on time without delays and resulting in cost savings. A lawyer's opinion, no offense to the lawyers in the room, cannot prevent against fraud, super priority liens, or inaccurate government responses, where title insurance can provide that coverage. Title insurance also provides coverage over zoning and compliance issues, as well as taxes. We also have a built-in defensive title coverage. And what that is, if you get nothing at all, this piece is the most important piece of coverage within the policy. If the insured's priority is ever challenged, we as a company, Stewart Title, will defend and cover all costs associated with that challenge to ensure that your priority is protected until the matter is resolved. And of course, we have no fault claims process. Title insurance is different from other insurance products. As I said, generally, title insurance protection is retrospective. As I've stated, it's a one-time premium paid on closing. There's no deduction to be paid on a claim. And the policy lasts as long as the borrower's interest in the property. There are some similarities with title insurance and other insurance products. One is the insured must suffer a financial loss before a claim is paid. And two, it excludes issues known to the insured but not known to us. So in this scenario, you have a purchaser come to you, you've loaned them money, they've closed on a deal. 6 months later, they make a claim to Stewart Title. We investigate the claim. We find out that they had prior knowledge to the issue. They didn't disclose it to you, and therefore you didn't disclose it to us. That would not be covered because that's a known issue. And what do we consider a commercial policy? Anything zoned commercially. Multifamily units over 6, farms over 2 million, commercial condo units. Anything under the zoning of a commercial umbrella, we would classify as a commercial. And with that, I'll turn it over to Steve, and he'll talk to you about title insurance basics.
Thank you, sir.
There's your clicker.
You broke it for me?
I hope.
We'll see. Okay, thank you, Chase. Thank you, David, the Lerners team, for having us here today. So we don't want to get too far into the weeds today, right? But I'm going to talk about some of the basics, our common covered risks. We'll talk a little bit about some optional endorsements that we have as well, and then we'll wrap up with a quick note on ID verification. All right. So Chase was just talking about known defects, right? And it's sort of a general principle of insurance. If you know about something that you suffer a loss about, we're not going to cover that. But I'm going to talk about how we can deal with known issues and how we can insure over them and help facilitate a closing. And so it's because for a lender, the loss isn't necessarily immediate, that we can insure more known issues, whether it's work orders, open permits, and so on. So for a lender, to suffer an actual loss, essentially the borrower needs to default, the lender needs to sell under power of sale proceedings, and then suffer a loss as a result of a covered risk. So we have a lot more wiggle room with lenders than we may otherwise have with owners. An example of how we can help, and we quoted on a deal just the other day, there were 2 open building permits, municipal bylaw violation, and the new owner was willing to accept or at least negotiate a resolution to those issues, but the lender, on the other hand, wasn't comfortable with that. They didn't know enough about the permits. They didn't want to advance funds without having some additional backup on that. And that's where Stewart Title and title insurance can come into play. So essentially, in that scenario, we provided some custom underwriting to cover over the potential loss and give that lender some comfort in closing with the known issue. So again, this all stems back to what Chase was talking about. You got to let the lawyers know, the lawyers have to let us know, and then there's a possibility that we can specifically underwrite it. So this coverage could be for, again, anything, surveys, permits, zoning issues that are known to the lender. And again, it's not a slam dunk to get it. And there's a couple things that we're going to look at here, whether it's how long the issue has been there, how expensive it could be. Again, in the situation of the open permits, is there a deficiency list? Do we have any idea, how much it might cost to fix it? And who knows about it too, right? So if it's a neighboring property complaining about access or an encroachment onto a loading dock or something, that could complicate the matter. Of course, if it's a dormant issue, it's just been sitting around and it pops up on a survey, we might have a little bit more comfort in that as well, and no one's actively pursuing it. And finally, loan to value. Very important. Really, it's ultimately what's going to decide what we can cover for a lender as well. So if there's enough of a buffer there, we'll feel more comfortable about the prospect of a loss. So again, in the example I gave of the open permit, that deal would have for sure been held up because the permit just came to light on the day of closing or the day before, if not fallen through altogether without title insurance. Okay, so issues not covered by title insurance. Sometimes it's just as important to know what's not covered than what is covered in the world of insurance in general. We always like to stress environmental issues. We don't cover that at all. This includes errors in environmental impact statements, so on. Essentially, environmental issues not covered. Building code deficiencies, something that we stress a lot on the residential side of things, but it's still very much applicable in the commercial space. We do cover lenders for open permits and work orders, but building code deficiencies just in and of themselves, they're never covered under a title policy. The value of the property, so in a down market, which is a very topical conversation right now, we're not covering if the lender sells the property at a loss. Whether that's through an inflated value because of the market or an incorrect appraisal or otherwise, we're not guaranteeing the value. And the big takeaway here is the quality of the borrower, right? So we don't cover for fraudulent loan applications, misrepresentations with respect to income, a fraudulent T4, anything like that. So we're not covering against a fraudulent misrepresentation by the borrower. And Nicholas was chatting about the PPSA registrations. That's not covered and essentially will be specifically excluded under a title policy. Okay, so some common covered risks. There's 5 main ones that we want to look at today, and all this ties into the why obtain title insurance and for private lenders as well. And so the first slide here is that we do have a somewhat arbitrary threshold for coverage at $50 million. That's 50 million, where some of the coverage for work orders, permits becomes a little bit limited. So as you can see, title defects, priority, fraud, survey, they're covered at every amount. And then zoning permits and work orders go from $1 up to $50 million. And so if you're doing loans over this size, we are somewhat flexible. It just means that we may be doing some more due diligence. Maybe there's some stat decks from the borrower or something that we need to get signed. So essentially, that's the line in the sand that we've drawn for those, but we encourage you to, ask questions or reach out if you have a $51 million deal and there's a potential that we could work with you guys on that. So, okay, Chase was chatting about the invalidity or unenforceability of the insured mortgage. This is just a quick blurb on what the language is in the policy for that. So we'll jump through that. And when we're talking about our basic coverage, especially for lenders, and everything we're talking about today, fraud, zoning, survey, and so on, it's all very important. But our coverage for loss of priority on title to, let's say, builder liens, property taxes, CRA, it's one of the basic principles of why you're obtaining title insurance. So one key takeaway is that we cover for CRA, super priority liens, for money received by a lender from a borrower who owes GST or employee remittances like EI and CPP. So our basic coverage is limited to as long as the insured has a registered interest in title. So this meaning, essentially after the mortgage is discharged, the lender has no policy and no coverage if CRA comes knocking on their door. So this is very popular coverage. You can all probably attest to this in the room that it's difficult to protect against these liens. Responses from CRA can be very slow. And borrowers, at least in our experience, may be more than happy to sign self-servicing declarations, right? Ultimately, it's where do I sign to get the money versus what they're actually signing in certain circumstances. So the takeaway here is essentially that our standard policy covers for the unexpected knock on the door from CRA looking to collect the borrower's arrears from a lender directly in what's called a deemed trust. So as long as the policy is still in place and the mortgage is registered, both residential and commercial policies cover liens that predate the registration of the mortgage. And so before I move on to the title fraud, we do have an optional endorsement that covers for post-discharge super priority liens. I'm going to talk about that in a quick second when we talk about our optional endorsements. But next is fraud, and this is the most important one, right? At the end of the day, if your client or borrower is asking, what the heck is this title insurance thing and why am I paying for it? The general sort of easiest way to explain it is the mortgage fraud component, right? That's how I explain it to my friends, family, what the heck is title insurance? It's, we're the backstop to mortgage fraud in its most simplest terms anyways. So mortgage fraud remains very prevalent. It is our largest claim category by dollar amount. Most lenders want the security to ensure their mortgage is protected, as Chase was saying. And so some of the things we look out for here in terms of flags are recent transfers or discharges, usually within the last 6 months. It's a relatively new scheme out there in terms of fake mortgages going on title. So the fraudster puts on a fake mortgage on title. They don't run money through the lawyer's trust account, and then they wait 6 months, a year, maybe later. And then they use new mortgage proceeds from a legitimate lender to pay out that fake mortgage. So that money essentially goes to a shell company for the fraudster. It's overseas by lunchtime, and the money's gone. So you can see the long game, some of the sophistication in that type of scheme, but it's one of the newest ones we've seen. I want to say we uncovered it, towards the end of last year. Maybe it was holiday time of last year. So that's something to be out on the lookout for. And if there is a private loan being discharged as part of the transaction, it could be that we do some more due diligence as well. So some other things that we look out for, though, changes in the directors or officers of the corporation. This is very easy to do. Usually if it's a rush deal, the borrower is okay with paying extra fees. That's never a good sign. Like, when is that, realistic in terms of, hey, yeah, we want to give you more money to rush this out the door. And again, we are the experts in terms of evaluating fake ID. We always encourage clients, lawyers, lenders, whoever it may be, to reach out to us for the extra set of eyes if it's necessary. This is, especially important with out-of-province ID. Maybe it's foreign ID as well that lawyers may not be familiar with. The out-of-province one is actually something that the fraudsters really tend to rely on. The Ontario lawyer might be familiar with the BC license or vice versa, but they may miss out on something small. And again, we have people on staff that are looking at the font size, the picture, the angles, the shape of the ID, all that sort of stuff. We've even seen frauds where the fraudster put the legal description in the address. And really, it sort of boils down to how focused or how much you're paying attention to that ID as well, right? So we encourage you guys to reach out to us and just be that extra set of eyes if need be. And so last but not least, this is very important on private loans. All the title insurers have this exception for payments being made to unrelated third parties to the transaction. So this is not applicable to institutional loans and specifically for private loans. And the reason the industry has this is that all the insurers do the same thing, by the way. We were all getting hit with fraud where the fraudsters would put pressure on the lawyer to send funds at the 11th hour to an unrelated third party. So it's easier to take off with the money that way. It's an extra step to have a bank account in the name of the person that you're impersonating. And it's not as easy to get the money out of the account as well, right? If it's a large sum of money, to get it out of that account quickly, so essentially the takeaway here is that if the funds are being paid to an unrelated third party, that's going to be a flag as well, especially at the 11th hour. Okay, so survey coverage. This is very important, but won't take us long to look at. It covers for losses due to matters that would have been revealed by a survey had one been done on the policy date. And your client may say, hey, I have an old survey from the vendor, or on a refi, maybe, I've been living there for a long time and nothing has changed. So while that may be true, we often see errors in surveys. So if the survey wasn't commissioned for the entity relying on it, they likely don't have legal grounds to enforce that error on the surveyor. And we had a deal just the other day, it was yesterday actually, came in, where the borrower was saying exactly that, saying, hey, we have one from the vendor, can we get out of the title insurance component? And the lender said no. So unless it's an up-to-date survey for the entity relying on it, generally speaking, title insurance would be the solution. And so there's a note here about excluding fences and boundary walls. It's a little bit more applicable on the residential side of things where neighbors are arguing over a couple of inches or a foot of land, but we will pay for a loss of value if there's lost land, but essentially we're not getting in the middle of neighborly disputes over where the fence should be. Okay, zoning, Chase talked about this really quickly as well. And some of our most important coverage is really quite simple to break down. We guarantee the existing permitted use as of the policy date to be continued. So if your client is borrowing on a restaurant, we ensure their continued legally permitted use as a restaurant, office, gas station, whatever it might be, right? So as you can see on the slide here, we cover for area, width, or depth of the land. We also cover for height, setbacks, and specifically for lenders, parking compliance and the amount of parking spaces. So again, keeping in mind the retrospective nature of our coverage that Chase was talking about, this coverage is as of the policy date, right? So we're not guaranteeing any future intended uses of the property. And so this coverage does go above and beyond what the municipality might respond with in their zoning search. And we do have some coverage for E&O in that search as well. So we have a government response endorsement. Chase mentioned it really quickly as well. In terms of getting something back where it says that there's no open permits or work orders, or that the use is something different, we will be the backstop to that. And the last thing on the common covered risks is for lenders here with work orders and permit coverage. So I touched on this earlier, but we do waive the search for this up to $50 million. So we provide coverage for work orders, open permits, and deficiency notices up to that amount. We also cover for improvements constructed without a permit when a permit was required. And it's a very important distinction too, something we spend a lot of time talking about with lawyers who do one-off commercial transactions for buyers, is that commercial owner policies don't get this coverage. Again, sort of immaterial for our purposes today, but we do like to bring it up. It is different than a residential policy, and there's the different policies in terms of the lender and owner coverage as well. So lenders get this coverage, commercial owners do not. Quick note here about some additional endorsements, remote signing, which brings us back to the fraud stuff. Construction lien is very important in terms of we have the ability to move policy dates forward with each advance, so you get your retrospective lien coverage with each advance. So if you're doing any construction work, that's some really good coverage. And we want to take a couple of minutes here to talk again about the lien coverage a little bit more and some optional endorsements that we have. So we do have 3 of them. They're all relatively new over the last few years. I think they were all launched over the pandemic as well. And the reason we bring it up is that we used to have a very generic policy, sort of one size fits all, no cost for additional endorsements, very straightforward. But as the industry has evolved, we do have 3 different ones. They're very important, but you do need to ask for them. They're not part of your standard commercial policy, so they need to be requested, and there is an additional premium associated with them as well. So we'll have a quick look at our post-discharge super priority lien endorsement. And so to take a step back, we already talked about our basic priority coverage and CRA claiming the deemed trust over registered mortgages. So we already know that coverage. And so what this does is essentially it provides the post-discharge coverage. So, if CRA knocks on the lender's door up to 10 years after discharge, unless you have this endorsement, there's no coverage under the title policy. So for an additional $175, that's the additional premium. Lenders get to continue their coverage for 10 years post-discharge for this specific issue. And so the last 2 optional endorsements here, the first is our extended protection endorsement. This is capped at $5 million. So we don't offer the coverage on deals over this threshold. And basically it's lawyer E&O coverage for lenders' losses as a result of the lawyer not following instructions in their agreement, in the loan agreement, or doing required searches. So the lender can make a claim directly to Stewart Title rather than going through the law firm. And I'm sure the lenders here, y'all have good relationships with your lawyers, be it Lerners or otherwise. We don't want to necessarily go down that road, but something we've seen a few times in terms of dealing with second priority mortgages. And Clark was talking about this earlier as well. If you're having the lawyer look to confirm, the ability to draw down on that first mortgage, or the status of that first mortgage, maybe the lawyer made a mistake in that, and there's some coverage available under this endorsement for that and some other things as well, in terms of it being a backstop against a statement of claim in the worst case scenario. And the last one I've got here for you guys, and I'm sure you're happy to hear me stop talking about title insurance shortly here, is our post-policy date lender coverage. And you can see it's not available for private lenders. We did want to bring it up because it is the newest endorsement in the industry. And who knows, maybe over time it'll become available to private lenders. But essentially, we've talked a few times now about the retrospective nature of title insurance. And so this covers for post-policy survey-related matters, future violations by the borrower of registered covenants, and essentially maybe the most important thing is work done on the property without a permit when a permit was required, and open permits and work orders. And at the end of the day, it protects against the unruly borrower who puts a swimming pool in their driveway or something ridiculous that you can't otherwise protect against. So that is really it on the title insurance side of things. We did want to leave you guys with a quick note on ID verification. So a new product that we have, and I guess it's a partnership with a company called Treefort. And essentially it's a 5-part ID verification system that we're currently using internally if we're trying to verify the ID of the borrower, or essentially if the deal we're finding it doesn't make sense. We're starting to use this internally. I think very soon it will be available to lenders and lawyers directly, and we're ramping this up with the new Law Society announcement in terms of lawyers being required to authenticate government-issued ID when signing up a client virtually. So as of next year, simply reviewing the ID online and virtually when you're meeting with a client won't be sufficient anymore. And this platform does meet the Law Society requirements. So essentially, there's a banking authentication component to it, a selfie component, because of course it's 2022 and there's a selfie component to everything. So, and what it'll do is, you do a selfie scan through your camera, and it sort of compares it to the ID that you've uploaded through the system as well. So credit check, some cell phone verification in terms of the address and some details in there. But this is sort of what's new in the world of ID verification, and I'm sure you'll be hearing more about it as we come into the new year. So that was it from us on the title insurance side. So thank you, David. Again, if there's any questions, we will be sticking around. But yep.
Stephen, let me get your thoughts on
Sure.
There was CBC Marketplace recently.
Yeah.
Altered.
The realtors, right? Yeah, I heard about this. I didn't catch it, but yeah.
Altered income.
Yeah.
Scores that people are using down.
Yep.
Toronto way to request to get approved for mortgages.
Yep.
What are your thoughts on that? Have you heard much of that going on down there? And what's the coverage there?
Well, so I guess the quick answer is there's no coverage for it in terms of that misrepresentation by the borrower or the realtor or anybody in terms of value of the property. Obviously, it's very concerning. But yeah, from the title insurance component strictly, there's no coverage for that. And this was specifically realtors. Like I said, I didn't catch the...
This was people altering their T4s.
Yeah.
Realtors were helping them out.
Yeah.
Altering their T4s so they could qualify for
Yes.
larger mortgages.
Yep. Yeah. No, obviously, definitely a problem, and a problem for lenders in terms of, potential defaults and inflated values, but definitely not something that we cover under title insurance.
Right. So for the private lenders in the room, I would, for sure watch that episode of CBC Marketplace.
It's funny, my colleague brought it up the other day, and I said to him, I'm like, oh, I definitely need to watch that as well. I haven't actually caught it, but I've heard a lot about it. Yeah. Okay. Thank you, guys. Thank you, David.
Thanks very much, Stephen and Chase. And to give everybody in the room an idea, title insurance is an important component for, obviously the reasons we've talked about, but one of the realities of the market is that things happen very quickly. And so, writing away for searches and such, sometimes you don't have the time, and so title insurance can play a role in getting things covered that, or getting a survey, for example. It's become less common, so it's an important tool in our toolbox, and we thank Stewart for being here and sharing that information. Okay, up next. Our next speaker is a partner and member of both business law and commercial litigation groups, Domenico Magisano. Dom is one of our corporate restructuring lawyers, and he is our go-to guy for mortgage enforcement matters. He is our enforcer. I was thinking that, we really need to get him kind of his own opening music, similar to like Jordan Romano or something coming into the Dome. But he is, and unfortunately, we are having to call him a little bit more lately. But as part of his practice, he regularly advises clients on mortgage and other enforcement matters, and in addition, negotiates purchase agreements, loan, and security agreements as part of restructuring and takeout deals. Please help me welcome Dom.
David, thank you for that. And yes, the black suit is intentional, given that I want to look appropriate for the end of the corporate finance cycle at this point. So the intention here is to, we'll go through the various processes that we have, court processes and private processes, and they apply both for real property and personal property security options. We'll talk about them both in some detail, and a bit of the, I'll rip through the last one because the last presentation really dealt with a lot of the priority payable issues that you can see as a result of some recent decisions of the Federal Court of Appeal and Supreme Court of Canada relating to the CRA's ability to claw back from lenders who have been repaid. So generally speaking, there are four types of proceedings, court-appointed proceedings for insolvency. There are other ones that are used, but they're usually for solvent entities, and there are insolvency lawyers who are now trying to shoehorn into plans of arrangement under the Corporations Act, Business Corporations Act. We're not going to talk about those today. Bankruptcy, court-appointed receiver, proposals under the BIA, and we are going to talk about CCAAs very briefly. Private enforcement, power of sale, and it's called something different, but that is available also in the personal property context. Foreclosures, again, called something different in the PPSA, but there are ways to address that. And then the privately appointed receiver, which is something that is not used very often, but can be useful in certain circumstances, particularly where there's limited risk of liability. So the court-supervised proceedings will usually require a court officer, and are there. And you got to remember, and this is something that often lenders forget. Once you go down the road of court officer, that court officer is not your employee. It is not your consultant. It is not your fiduciary. It is a court officer there for the benefit of all stakeholders. It does not act just because you say so. Although often, if you're the primary lender and you're the person with skin in the game, your view will have heightened importance, but they have an obligation to everyone. The court processes are generally more expensive, but they provide a lot more protection to both the lender and to the court officer who's enforcing on it in terms of, and we'll be talking a bit more about the risks, but litigation risk is a big one, and just generally a more streamlined process. So when we talk about the four types of court-supervised processes, two are what are called debtor and possession processes. So in those instances, the debtor remains in control of its operation and its business. The court officer oversees the process, reports to the court, and makes recommendations on what the debtor is doing. And the upside to this is the company continues to operate, or the entity continues to operate. For companies that are larger than $5 million, they have the option of both a BIA proposal and proceeding under the CCAA. For companies that have less than $5 million in debt, they will only have the option of the BIA proposal. So when we talk about the other two options, we are talking about bankruptcy and a receivership. That involves a transfer of the assets or the property from the debtor to the court officer. So the court officer is now in control. The debtor, as much as they often try and say otherwise, is not in control of the business and the operations or the assets in that situation. The court officer is then tasked, rarely to operate the company, more likely to secure the assets, sell the assets, distribute the proceeds. That's the end result of that process in the court sponsored parts. There are, and when I say occasionally operate, there are instances, particularly in the manufacturing area, where a receiver will go in for a brief period under some contract with a third party to clean up existing projects that are on the floor, and they may run for a brief period of time, or sometimes an extended period of time, to maximize the value of the assets for the stakeholders. I always tell lenders that we have to remember the hierarchy that there is in terms of loans that are made and the creditor claims in an insolvency. There are some secured creditors that think they're at the top of the heap. We heard a bit earlier, that doesn't always happen. There are trust claims, and we talk a lot about deemed trust claims because those are the ones, frankly, we see most often, but actual trust claims matter as well. And I'll spend a minute here to talk about that. Deemed trust claims, for those who haven't heard that term before, are trust claims that don't fit the common law concept of trust, something that lawyers talk about as the three certainties. But legislation has said, we don't care that we don't meet that. We are going to impose a trust claim because we think this is of sufficient policy importance that we need to prioritize this. So you see it with respect to funds that are collected by companies for HST, employee remittances. Those are the two big ones you see. But I stop here because I'm assuming some of you are in the construction-related businesses. The courts have also said that just because a trust claim in the Construction Act may or may not hold water in a bankruptcy, and that may not be the be-all and end-all of the discussion, if that trust claim can actually meet the express trust claim, so the three certainties. And in many instances, that has changed the way, particularly in a receivership or a bankruptcy, that monies are held by a receiver and a trustee. So lenders need to be aware of that when they're lending into a construction project, and they need to understand that regardless of what the Construction Act says, the courts can go beyond that and say, I actually see an express intention to create a trust, and that will be in priority to the lender. Behind trust claims are secured claims, which are mortgages, PPSA, security, GSAs, and the like. And then at the bottom is the unsecured claims. So, and some of this is maybe rudimentary. Secured claims are ranked in order of priority. So usually it's by registration, but there are a number of different ways that can be played out. But person at the top of the heap has to be paid in full before second, before third. Unsecured claims generally share pro rata. As any good lawyer does, with every rule, there are exceptions. Purchase money security interests are one such exception. So purchase money security interest is often seen in equipment inventory, excuse me. And that is an instance where a lender lends specific funds for a specific piece of equipment or for inventory. And regardless of where that registration is completed, it will have priority if it meets the criteria under the PPSA. Deemed trust claims, I'm not going to continue. We've talked about that a fair bit. Lien claims, again, important, particularly in the real property sense. If there's a lien claim registered, advancing in the face of a lien without clearing that lien, obviously problematic. The last one is something that we don't talk about a lot, is preferred claims. In a bankruptcy under the Act, there are certain types of unsecured claims that are given a heightened priority. And so they would take behind secured creditors, but ahead of unsecured creditors. There's a number of different ones, and I'm happy to talk about them, the specific ones, if there's any questions. Private enforcement is often is the other way to go, frankly. There are two broad heads. One is, I want to sell the assets and take as much money as I can to pay off my debt. And if there's any deficiency, I want to retain the right to sue on the covenant. Or if there's excess money, I agree that that money needs to be distributed to other people beyond me. I don't get the excess. Retaining the assets, foreclosure, I'm keeping the asset in lieu of my debt. If there's a deficiency, I'm accepting that I have no further claim with respect to the deficiency. If there's an excess, I get to retain the asset. I get to retain the effective excess because I'm retaining the asset in lieu of my debt. It's important to note, accepting assets, particularly in the real estate context, more difficult from a legal perspective. But in both the personal property and the real property perspective, if somebody contests it, it is very difficult to proceed with foreclosure. You often get bumped into a sale in any event. Okay. So when deciding between private enforcement and court-appointed protections, these are often the considerations you have to look at. If there are other creditor interests, if you are not the only secured lender, you may want to consider whether or not a court officer in a court-administered proceeding will make it easier to address competing creditor claims. Litigation issues, I recently had a file where there was a mortgage lender and an equipment financier that were competing over the assets, how to divest the assets of a cannabis grow-up. And by the end of the submissions, it was pretty clear that we could have had up to 4 pieces of litigation if the private enforcement option favored by the mortgagee had proceeded. Everything from determining quantum of security that needed to be put in place for the equipment lessor to remove its equipment, to improvident realization claims, to damages claims for removing equipment. There were literally 4 different types of litigation that would have spawned or could have spawned as a result. So that militated in favor of a court process to simply avoid. It would have avoided 3 of the instances of litigation, and the 4th one would have been addressed by way of motion rather than action. So while in first instance the private enforcement seemed cheaper, in the long run it was probably going to be cheaper to do the court-appointed officer process. Very quickly, we've talked about this. The priority payables issue is a big one and a real one now for all lenders. The courts have said, as you heard earlier, that the CRA has the right to claw back from lenders ex post facto unless there's evidence of due diligence. And what that means, due diligence, is still not clear. I can tell you I act for lenders that have varying levels of comfort with respect to what they'll do in terms of due diligence, everything from simply making a request of the lender right up to refusing to discharge their security until they get some sort of comfort from CRA that the priority payables were current up to the date of payout. The latter is extremely hard, extremely expensive to get, and often is qualified from the CRA. So it is a problem. It is a risk assessment for lenders at this point in terms of what you do on a payout. I'm still waiting for the case that will come across my desk where a borrower insists on a payout and the lender says, I'm not discharging my security until I get comfort, and that ending up before a judge, and a judge having to determine how to address the borrower's right to pay out a debt and the lender's right to have comfort that it won't be clawed back. I have some views on that Court of Appeal decision, including some of the comments at the end about how lenders can just simply ask for a third-party authorization and speak to CRA, and they should be able to get all the comfort they need. Anyone who's gone through that process may realize that that's easier said than done. But it is important to keep in mind, I generally recommend that you get some sort of comfort at the front end. You get some comfort when you're being paid out, and to the extent that you can retain some portion. Often there's a business risk, people want their money. Sometimes there's a way to negotiate something with the takeout financier to take an assignment of your position. That's one of my preferred ways of handling these matters if the other lender is amenable to it, because that is a transaction that is outside of the debtor realm. It's 2 lenders trading paper, for lack of a better term. So that is one of the ways that people are using to get around that as well. Insurance is always a great way too. With that, are there any questions? Yes.
Who determines determines, I guess, whether you go court appointed or private enforcement? Is it the first priority lender, or I guess, if the second guy in line wants to go court appointed and the first guy in line doesn't, I guess how does it get determined which way to go?
That's a good question, and it's a fact-specific question, depending on the nature of the interests between the parties and what evidence is before the court about each party's ability to be repaid through a process. Often a first mortgagee, I'll use a real estate context here, often a first mortgagee will say, I'm agnostic on how we proceed because I'll get my money regardless. I know I'm well secured. And the second mortgagee goes, well, wait a minute, before you spend my money because I might be out here, I'd like to talk about the most efficient way to do that. And courts have gone either way on that. It really is a fact-specific determination. Sometimes it also often involves caps on court officer fees, or discussions about how that gets funded on distribution, particularly if the first lender is adamant about proceeding through a court process. It's a fact-specific question is the short answer to that. Yes, David.
Any impact in terms of, we hear about backlogs in the courts, and is that having any impact on the enforcement proceedings from your perspective?
Good question. There is, cases in the GTA are, insolvency-related questions are funneled through to commercial court. Commercial court tends to be very responsive and fairly quick and timely, even in these situations. You're talking weeks, not months. The London court, I can say, has a unofficial insolvency group that if you say that this is a bankruptcy and insolvency matter and it has some urgency to it, they try and find a way to deal with you. And they've handled that quite well historically. Smaller centers, you will have some concerns and some problems. So it really depends on urgency, and it also depends on what exactly we're trying to enforce upon. Residential mortgage enforcement, our office has recently moved from issuing claims for possession to issuing applications for possession. And that was a strategic move to address the fact that in many smaller centers, there's weekly motions lists. And an application is treated as a motion, so you can get in relatively quickly. Whereas if you start an action, trying to get a summary judgment motion can take several months or longer. So that's one example of something we're doing. That doesn't work in every real estate enforcement option. Likewise, if you're talking about a receivership or a bankruptcy of a large company, we often try and find if there's a way to have the matter dealt with in London or Toronto or elsewhere. If there's a nexus to those centers, or we can do that, we will. If it has to be court appointment. Now, I don't have, to answer the specific question, I have had few lenders come to me and make decisions on whether to proceed privately or by court appointment simply because of the time lag. It's more of a risk tolerance question and an efficiency issue in terms of what they believe they can get done privately versus spending the money for a court appointment.
Tom, what are your thoughts on, let's say, a commercial tenant? We know they're in trouble, and they haven't paid their rent, and we're worried that they're just going to overnight clean out shop and disappear. Just with all their assets inside the building, whatever, they get some cranes, they move some stuff around, all of a sudden everything. I show up at the business and everything's gone. What are the actions around kind of legally? I guess, how do we go find this stuff?
Well, find is an investigator, but in terms of the Commercial Tenancies Act actually has a provision, what's colloquially referred to as the midnight run provision. There is director liability tied to that if you can prove it. So there are litigation options to address that. If you are aware of it midstream, you can, I hate to talk about it in the abstract because each case would be specific, but there are ultra aggressive commercial lenders that will change the locks midstream and just not allow access. That usually, it depends on what the tenant wants to do at that point. That's certainly not, that doesn't follow the strict letter of the law in the Commercial Tenancies Act. You can also move rather quickly. Again, if you're in a center where you can get in court rather quickly, you can often get court orders to assist you in relatively short order. It is rather expensive, so there's a cost-benefit analysis depending on the solvency of the tenant. So if you're already concerned, the one caution I have for landlords who are concerned about that is hopefully you have some comfort that those assets are not already encumbered by a lender, because you might spend a lot of money doing a lot of work for somebody else who will say thank you very much. So make sure you know what you're getting into before you go down that road. On a fact basis, not on a legal basis. Well, legally, go talk to your lawyer. Fact basis, understand what you're dealing with in terms of those assets. Okay, thank you.
Before we wrap up, does anyone have any final questions for any of our panelists? All right. Well, we'll let you get an early jump on that traffic. Thank you so much to everyone who attended today and all of our presenters. We really appreciate your interest, and we are able to provide a copy of the recording today in case there's any information that you want to refer back to. There is a sign-up sheet near the door. Also, please feel free to stick around and say hello if you have any questions. And you can also reach out or connect with any of us on LinkedIn or by email or phone. Our cards are conveniently stashed in that little billfold or wallet or whatever it is that you've been given. So you can, of course, you can throw your credit cards in there, but keep our cards in there too, because you never know when you're going to need us. So once again, thank you very much for attending and enjoy the rest of your day.